Hello and welcome to Portfolio Matters. In today's episode, I will be talking about the housing market. Now, in the weekly, we have been covering developments in the US housing market pretty much every week. Now, why is that? It's because there's very good reason to believe that the housing market is the business cycle. And as the housing market turns down, it is both a predictor of and a contributor to recessions. Now, I won't be talking about stocks, and so I won't do a full disclaimer, but as always, please do your own research, and a full disclaimer can be found at the end. Okay, to summarize this presentation, the housing cycle is not a price cycle, it's a volume cycle. So house prices tend to be very downwardly inflexible. House prices tend not to go down. Instead, what happens is the volume of houses sold collapses when there is a downturn in the property market. And as I've just said, the housing cycle is both a predictor of and a contributor to recessions. So first of all, an overview of the housing market. So residential housing is a unique asset. It's both a home and a financial asset. And people buy houses in part for their price appreciation, and they buy them with debt. If house prices are rising, buyers anticipate further rise in the future, and they tend to bring forward their purchase plans, and that adds to demand. Whereas if house prices start to fall or stagnate, then buyers have an incentive to wait in the expectation that prices will fall further and they'll be able to buy a house cheaper in the future. But sellers are averse to lowering their asking price. So as market prices fall, they simply choose not to sell their houses. And if house prices fall below the price at which they purchased their house, then they're in negative equity and they simply may not be able to afford to sell their house. And sellers tend to have a nominal price target for their house. So they'll be thinking this house is worth £300,000, and they will wait to sell it until they feel that they can achieve £300,000, ignoring the effect of inflation. So they prefer to receive £300,000 no matter what the real price is after inflation. Also, houses are purchased with debt, and debt in the form of bank loans. So credit affordability is a key determinant of the housing cycle. And banks prefer to extend mortgage loans when house prices are rising, and they anticipate further rises in the future because that gives them good collateral on their loans. When house prices start falling, then that incentive disappears, and you'll find that banks tend to step back from the mortgage market. Also, mortgage rates, and therefore house affordability, is a function of interest rates. And banks' profit margins are also a function of the interest rates and the shape of the interest rate curve. So what banks are doing is they are borrowing from depositors short, so they pay the depositors the short-term interest rate, then they're loaning money to mortgage holders at long-term rates. So if there is a good spread between short-term rates and long-term rates, banks are incentivized to lend money. If the yield curve flattens, which it tends to do during recessions, then banks are not compensated for the risks of lending money long, and they tend to step back from the mortgage market. So the other special aspect of housing market is that the house is a home, which is a durable asset which people live in for very long periods. So the stock of existing homes competes with current production. So during a boom, when a lot of houses are built, any excess stock then competes with new production. And so the excess stock has to be worked through, has all to be sold before new construction becomes competitive again. In addition, house buyers will already be living somewhere, which means that they can extend their current living conditions generally until they feel the time is right to buy a new home. So generally there is no immediate need to go out and buy a house if the conditions are wrong. Buyers can wait until they feel conditions are right before making a huge purchase. So in summary, the housing market has positive feedback loops when prices are rising. Rising prices mean that buyers push forward their purchasing plans in the expectation of future capital gains, which means that they add to immediate demand. Banks also have an incentive to lend money in a rising market, and so they facilitate more purchases. But when the housing market turns down, that feedback loop reverses, but with the addition that sellers refuse to sell at lower prices. And therefore, what happens is that prices do not correct downwards by very much. Instead, what happens is that the volume of houses sold collapses. And that means new construction activity collapses. And that has big economic effects. One line summary: the housing cycle is a volume cycle. It's not a price cycle. Okay, so more on the fact that house prices are downwardly inflexible. So these are US house prices since 1963. And you'll see it's pretty much a constantly rising slope. There are a few wobbles during recessions, but what's remarkable is during those recessions, house prices barely fell. The only time they really fell in a meaningful way is during the Great Financial Crisis. And so these are the annual changes in the median house price using quarterly data. So if house prices fall for 1 year, that would yield 4 data points. And you'll see that house prices fell hard during the Great Financial Crisis. And apart from that, there are only really serious falls in the early 1970s. The rest of the time, house prices have tended to rise. During recessions, there have been periods where house prices either fell slightly or just stopped rising. But rarely has there been a period where house prices have fallen over the course of a whole year. Now, if you contrast that with the stock market, you'll see there are very regular downturns in the stock market. If you look at the annual returns of the S&P 500, you get lots of drawdowns. So the housing market is very distinct from the stock market. Prices don't like to go down, whereas in the equity markets, prices are very volatile, both upwards and downwards. So what then is the particular role of housing in causing recessions? Now, the first thing to say is that residential investment is actually a tiny part of GDP. Between 1985 and 2006, it contributed only 0.13% per annum to total GDP, which grew at 3.1% per annum. So residential housing contributes only around 3% of overall GDP growth. But residential housing contributes enormously to the business cycle because it is so volatile. Now, this chart shows the abnormal contribution to GDP growth of residential investment. You see, it's very volatile. It swings from plus 1% to minus 1%. So that is a change of 2% to GDP growth. So that the move in 1973 to 1975 from peak to trough will have depressed GDP growth by 2%. And that is a big contributor to the fall in GDP. If we look at consumer behavior around 7 recessions, so the vertical line is at the peak of the business cycle in 7 recessions. You see that various measures of consumer spending fell in the quarters prior to the peak. And the biggest fall was spending on residences, followed by spending on durables. In contrast, spending by businesses essentially didn't move at all prior to recessions. It moved after recessions. So business expenditure did not contribute to these recessions. Businesses reacted to recessions by cutting expenditure, which further worsened the business cycle, but they didn't cause it. Government expenditure hardly changed either before or after the start of the recession. This chart is difficult to interpret, but essentially, during a recession, both imports and exports fall. And imports generally are a negative contributor to domestic GDP growth. So the drop in imports actually is a positive for the economy, while the drop in exports is a negative for the economy. All that suggests that falls in residential investment lead the economy into recessions. And so if we look at the gray shaded area, this is the abnormal contribution of residential investment to GDP. And when this line starts to fall, we should expect to see a recession, which is the vertical bars, soon after. And if you examine this chart, you'll see that is largely true. There are 2 exceptions. There is the first circle here in red in 1952-53. So there's a big drop in residential expenditure in that period, but no recession. But that was the period of the Korean War, and the thick black line is defense expenditure. So what happened then was the fall in residential investment was more than offset by a huge rise in defense spending, which kept the economy going. The other fall in residential investment that did not cause a recession was in 63 to 65. But again, over that period, there was a huge rise in defense spending caused by the Vietnam War, which kept the economy going and there was no recession. And the charts I present here are from a paper published in 2007. And you'll see that then residential investment was collapsing. And so there was a chance to do a live experiment to see whether that fall in investment would cause a recession. And we know that it did. The great financial crisis was not long in coming. So that data point also predicts correctly a coming recession. So in summary, the housing cycle is the business cycle. The weakness in residential spending precedes recessions, whereas weakness in service sector spending coincides with recessions. So what is the mechanism by which the housing cycle causes recessions? Well, if we look at housing starts, they're very cyclical. And this comes back to the point that the housing cycle is a volume cycle, not a price cycle. And so we saw that during recessions, prices were downwardly inflexible, but the number of housing starts collapsed. That means employment collapsed. So if we look at total employment in the US from the period 1940 to when this paper was published in 2007, you'll see that it is pretty much a constant upward sloping line. There are almost no dips in that line. So employment tends not to fall much even during recessions, apart from in the manufacturing and construction industries. So this light gray thick line is construction employment, and that's on the right-hand scale. You'll see there are distinct drops in construction employment, and that is a logarithmic scale because it's really volatile. So you see that, so these drops are of the order of 30%. And the black line is manufacturing employment, which is also volatile. Although since 1980, it is in structural decline. So this is US construction sector employment on a linear scale. You'll see that during the Great Financial Crisis, it collapsed from what, 7.8 million to 5.5. So it dropped by a third. So these are big swings in construction sector employment. And you see during the recent pandemic, there were big layoffs very quickly. This is manufacturing sector employment, which is also volatile. So something we've also discussed on the weekly is how moving house is also a key driver of consumer expenditure. When somebody buys a new house, they also tend to buy new appliances, so washing machines, tumble dryers, also soft furnishings like carpets, sofa, curtains, etc., etc. So housing market activity is a driver of demand for manufactured goods. And as the housing market turns down, it tends to also cause a drop in demand for manufactured goods. And that leads to a fall in manufacturing sector employment. In contrast, this is the chart of service sector employment. And it don't fall much during recessions. It hardly moves at all. So the service sector does not really respond much to recessions. It neither causes them nor responds much to them. And this is construction sector employment over the past decade. You see It's been growing in pretty much a straight line apart from during the pandemic. So in some way, although construction employment is a small part of total employment, it's highly cyclical. And it's both a predictor of and a contributor to recessions. So I hope that those charts have managed to convince you that the housing cycle is a key driver of the business cycle. But if that's true, the Fed should be aware of that and should be consciously targeting the housing cycle as a key driver of the business cycle, but it doesn't. In setting the Fed funds rate, it mainly looks at inflation expectations and employment. It doesn't look at residential investment. And by ignoring the business cycle, there is the danger that the Fed is targeting the wrong variables and has made errors. So these are US new home starts over the past decade. And you'll see that during the pandemic, they dropped sharply, but then recovered very quickly. Now, if we believe that the housing cycle is the business cycle, that should mean that the economy would recover very quickly once the rest of the economy was allowed to. But this chart shows the assets of the Federal Reserve as a result of QE. And you'll see after this initial surge, the Fed kept on adding to the balance sheet. Now, if you believe that the business cycle is a housing cycle, that was all unnecessary because the housing cycle was predicting the business cycle would be quite normal and was recovering. And this is interest rates. And again, the housing cycle bounced back quickly. And so did the Fed then need to keep interest rates at zero for as long as it did? So this is the net effect of Fed policy. US M2, that is notes and coins in circulation plus bank deposits, rose by 1/3 in 2 years. And so inflation was the inevitable consequence of excess money printing. So if the Fed had targeted the housing cycle, which was recovering, rather than inflation, which remained depressed, then it would not have had to keep monetary policy as loose for as long as it did. And in retrospect, it's clear that the Fed printed far too much money and has caused the current inflation. In conclusion, the business cycle is caused by consumer behavior, not by corporate behavior. It's a consumer cycle, not a business cycle. We saw that business expenditure did not decline until after the start of the recession. The main contributor to the consumer cycle is spending on residential homes, which makes home construction a leading indicator for the business cycle. And job loss or creation in the construction and manufacturing sectors are leading indicators of the business cycle and is something we should watch on a monthly basis as leading indicators going forward. And finally, by ignoring the housing cycle, the Fed made serious policy errors during the COVID pandemic by continuing QE and keeping rates at zero for far longer than was necessary. Okay, that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.